Hey everybody, stock chart of the day here. Uh yeah, so quickly, just so you know, some of you will be start getting emails from us from Substack. So I'm setting up a Substack. This is it right here. I'm just editing it right now. So Substack is kind of this blog newsletter. It's become like the biggest newsletter website in the world, one of the biggest in the world. Definitely probably the biggest for financial newsletter. So what I'm doing is kind of having tiers of service now where obviously you get the lifetime memberships, kind of the top tier, and I can start doing bonus things for lifetime members. And then you have the Patreon. The Patreon is basically just our weekly like video updates for members. And the Substack is a little more expensive. It's $27 a month rather than $7 a month. And the Substack will be basically, and for those of you, by the way, who've signed up through Lifetime, everything I do on the Substack, I will put on the website as well. Okay. So, but the Substack's going to be like daily vlogs, daily a daily podcast. I'll probably have 2 to 3 updates a day. If I see something interesting in the market, I'll do a little maybe 100-word, 200-word a vlog on it. It's gonna be very, very unique Substack. I'm gonna be very active on it. Maybe when we get into the dulls here, the summer, maybe I'll have a post a day or a post every second day, but definitely once we get into the fall, the Substack will be very active, 2, 3 posts a day. And it'll be nice because like what will happen with it, with Stock Chart of the Day Substack is it won't be intrusive in your day. Obviously we do these videos, the podcast will be 5, 6 minutes in length, and maybe the vlog update will be 100, 200 words, be the kind of thing, hey, you get the update that I've done it. Maybe you're at the grocery store shopping. You put the groceries in the back of your car. You pick up your phone. You read the 100 words while you're sitting there. You start your car up and leave. Or you get up in the morning. You have your breakfast. You have your phone in front of you. I don't know. Maybe that's antisocial with your family, but you read the 100, 200 words and you move on. So, and I will have like a recommended list. I already have that, but I got to get like an official list because I have 2 lists right now. I have kind of this trading vlog service, which will be on the Substack. And then which is like a combination of small cap trades, options trades, financings. And then we have our our larger portfolio watch, which has got the stocks like Fubo and these value stocks and dividend stocks and that sort of thing. So that it's going to be, I'm really excited. I kind of wanted to build Stock Chart of the Day and get a good feel and idea for it before I really got into the Substack. So, but now I'm getting pretty excited about all of this. And hopefully some of you, and for those of you that are on Patreon that would like to upgrade, feel free. I don't really have that many people on Patreon because I haven't pushed it that hard. But feel free if you'd like to um, cancel the Patreon and then upgrade to the Substack. So if you feel free to do that, and et cetera, et cetera. So anyhow, I thought I'd just show you that right now. So today's stock chart of the day. So this is how we're changing things. I know I've talked about how I'm going to change stock chart of the day going forward. My initial plan was to build this huge page on YouTube and then have all these sponsor companies. But the problem is that takes away from me doing my stock research. And I think one reason I've done well in the last few months, after kind of having kind of we all have downs in the market, having a down period. And we've had these dividend stocks do well. I'm hoping that Fubo does pay out, but pay off. And then of course a couple other ones is I'll have much more time to concentrate on this. And I'm still going to be active in junior mining. I'm still going to do a few deals a year, but I am someone I despise conference calls. I hate sitting there all day having to listen to guys, blah blah blah. I just like to sit here in my house, look at my view in the Bahamas, listen to the palm trees. I know my neighbor's playing. I've showed you my neighbor playing sax. He's playing sax right now. Listen to my neighbor play sax, play my own music, and research and write all day. That's what I like to do, right? So I'll probably do a handful or two to four deals a year, and I'm gonna be much more selective. My philosophy was before is just keep doing junior deals, keep doing, and then a couple are gonna pay off 5, 10, 20 to 1. But now I'm just gonna try to hopefully find out of the 4 I do a year, that, and just like, kind of weed out, a lot of the weeds, and just kind of try to pick the beautiful flowers, you could say, right? So anyhow, I just wanted to show you that. So what's going to happen in about a year's time, I have 4 sponsor companies right now, obviously going to allow them to keep sponsoring on the site. The last sponsor company ends at the end of June. So that will be the current, free stock chart a day. You're saying we're seeing that we do 3, 4, 5, 6 sometimes free charts a week, and then we have a 1 or 2 weekly members updates. It's going to switch then. Then I'm going to do 1 or 2, stock chart of the days. I guess you could say stock chart of the weeks, but anyhow, stock chart updates a week for free, and everything then is going to move behind the paywall after that. And I'll probably mix it up with 2 free updates a week with one of the stock charts and maybe an interview with another analyst or a company, etc. That's essentially what I'll do going forward. And what I think I might do with the sponsor companies is rather than charge them a yearly fee, charge them, I don't know, like a small amount of money, $1,000 or something like that. Once I build the list up bigger for the interview, and then and again, I'll try to handpick some good companies for you. So, anyhow, that's the plan ultimately. So we'll still go on like this till the end of June of next year. I built this thing from nothing because I was never really that active on YouTube, and I was really focused from about 2017, 2018 on my consulting business in terms of raising money for companies, doing marketing for companies through third parties, et cetera, et cetera. And so I've kind of always, I guess you could say, evolved just from the newsletter to that, and now going back to this form of a letter. And then, I'm also writing for a company called Dollar Collapse, or a website called Dollar Collapse. And then hopefully when my book is published through Newsmax in January of next year, I'll have another newsletter there as well. So you'll find me all over the place. And of course, I write monthly articles for Financial Intelligence. So anyhow, that's a little boring stuff on myself. I'm going to have a great video for you as an overview. I'm pitching a very large YouTube site right now. I don't want to say pitching, but I just sent them this big overview on macro overview of markets, debts, interest rates. So I'd kind of like to get on their show because this is one of the biggest podcasts, kind of business / finance / entertainment podcasts on the internet. I don't know if anything will come of it, but what I'll do is I'll give them a few weeks to respond. But I think this is one of the best videos I've ever done. And I'll definitely be posting it on Stock Chart of the Day if they do not get back to me. And maybe even if they do get back to me, because then, like that means they had to, but I want them to see it first. Hopefully it works out. Keep your fingers crossed for me. So, okay. So today's Stock Chart of the Day is the S&P price to sales ratio. So this is something that I really love, price to sales. This is something that a lot of people watch. And the reason being is, especially with all the financial shenanigans, financial engineering, whatever you want to call it now, people can hide earnings and priced earnings in that, because you can buy back stock and decrease the number of shares you outstanding, you can increase your earnings per share. So let's put it this way. Like, let's say a company earns $100 million and they have 100 million shares out. Just make it simple. They make $1 a share. Well, say that in the next year, they buy back 10% of the shares and then their earnings don't go up, stays at 100. They still make, their earnings go to 111 a share. So it looks like the earnings per share has grown 11%, but actually they're making no more money. And if you adjust it for inflation, they're making less money, but their stock may go up 11% or more because, it looks like they're making more money on a per share basis. And that's what companies are doing. That's called financial engineering. So what's great about price to sales, you can grow sales. Like, you could dilute the hell out of your stock and do takeovers and maybe ruin your balance sheet doing takeovers with debt, etc. But for the most part, if you're a large company, like NVIDIA has been growing, why? Because they're selling more chips, right? If you're a large company, you have to grow your sales, right? Like, one problem that BlackBerry's had, and when BlackBerry's a $2 to $3 stock when it used to be over 100, is even though they've restructured the company and they're not going to go broke and it's a leaner company, and now they're focused on kind of like AI themed technologies, self-driving technologies for cars. Obviously they do security for governments. They don't do cell phones anymore. The problem is BlackBerry, the cell phones made up, was their business. So now they're making a 50th of what they used to make, in terms of revenue. So so they cannot hide the sales decline, right? Especially because they did not have the money to buy back, 90% of their stock. So that's been an issue with them. And that's why the stock has gone down so much, because it's a much smaller company now. And the price and market cap of the stock had to reflect that. So anyhow, but this is the price of sales of the S&P. So the mean of this is about 1.5, 1 to 1.5 over the years. During the dot-com bubble, it got to about 2.5. Now this only goes back to December 20. I think it was actually 2.3 at the top. It just goes back to December 2000. You see it was at 1.8 there. And then you can see, at the bottom of the dot-com bust, it went almost 1 to 1, 1.7. And then that was the time that we were very cheap in the markets. When we went under 1x sales for companies on the S&P 500, we went to 0.8. It's the first time we've done that in well over a decade. And then we can see we've slowly climbed during this bubble. And we had a huge explosion when all of these small tech companies, boomed. Like I talk about Fubo. Fubo was having nowhere near the revenues it had in 2021, but it was a $60 stock. Now it's a $1.40 stock, and it's trading at a quarter of its sales. So that's an example. Like Fubo was probably trading at 50 times its sales back then, right, or more. So that's the problem. The 3D printers were like that. They were trading at 20, 30 times sales back in 2014. And I've talked about them. Now they're trading at like DDD is trading at less than 1 time sales. So we can see when all these companies that made minimal amounts of money or very small cap companies kind of got this bid during COVID. These were like, again, stocks like Fubo because it's a streaming service, or Peloton because people were buying those indoor, bikes because they couldn't go to the gym. Their stocks surged in price. So we went to a record high of 3 times sales, 3.04. So right now too, when people are telling you, oh, this is not like the dot-com bubble, all of these big tech stocks make money. That's like, okay, maybe they're not bleeding money like the dot-coms were, but look we're at 2.93 times sales. This is other than that top of that 2021 top post-COVID, which by the way was followed by a 25% decline in the S&P and a 30% decline in the NASDAQ. We're almost back at those levels, just like we're almost back at the same market cap to GDP. So again, by these metrics, we're very overvalued. And that's why I am somewhat ignoring the fact that the PDEs are good, and that the breadth is good in the market, and we've seen a kind of little broadening the rally. I just think that's a lot of influx of cash into everything on the feeling that Trump will win and that he's more pro business and pro markets. So it's just hard for me at these levels. Like, look, if you had gotten out in mid 2020 when this went above 2.5, okay, you missed the last 3-4 months of the rally, which wasn't very much, and then you missed this whole decline. So, and it never got below 2 times, which is still not cheap, but so you can't totally just trade on it. But when you're at almost 3 times sales on the S&P 500, you can't be chasing stocks here. And I know I always hate being bearish so much because people view me as a perma bear, because in 10 years ago, 2014, 2015, I was convinced the market was going to tank then. And we had a very good size correction in 2015, 2016, and then another one in 2018. But I was wrong in that, like this bubble just got bigger and bigger and bigger. So I try to keep an open mind. But again, now when you get these extremes in these valuation metrics, and you can see at 2014, 2015, we weren't at these extremes in price to sales. We were higher level than the median. You can see the median's 1.56, but we were but we weren't extremely overvalued. And now we're extremely overvalued. We're getting to the point where we're almost twice the median, which basically was only hit in in late 2001, right? So I just wanted to show you that, and if we go look at sales per share in the S&P, you can see the same kind of thing here. Sales per share in the S&P, are that like the highest they've ever been, but of course that's because the sales, the price to sales is also the highest it's ever been, right? So anyhow, I just wanted to kind of show you that. And I think this is just another sign that we're seeing very, very high valuations in the market, et cetera, et cetera. So anyhow, I hope you enjoyed this. I'm going to get back to working on my Substack. And just another reason just to be very cautious here. And look, we're hitting into now the seasonal time, that July, August period into the fall when stocks do poorly. And even in 2021 and 2023, when stocks did well, there was a correction from August into October. So I just say, keep your powder dry, whatever. You got the rest of you got what, almost 2 months left in the summer. I guess not quite, because Labor Day is kind of early this year. You got like maybe 6-7 weeks in the summer. Do whatever you do in the summer. A lot of people like me just continue to work and do your work or don't do your vacation and don't worry about overly actively trading. And let's just wait to see what happens in the fall. Okay. And everybody take care, and I hope you enjoyed this.